Welcome, ladies and gentlemen, to this webinar on inflationary environment and fixed income trading strategies to take advantage of it. I am Mahesh Bhimalingam, Chief European Credit Strategist at Bloomberg Intelligence. Bloomberg Intelligence is the research arm of Bloomberg LP. You all know about Bloomberg, but Bloomberg Intelligence, being the research arm, the specialty of it is independent. It is probably the largest research franchise on the street, about 450 analysts covering 2,200, 2,300 companies, 500, 600 credits, and every major market, including me as a European credit strategist. So today we've got three guests, Aitor, Zubeldia, Gary Giro, and Brendan McLean. I will let all three of them introduce themselves one by one. Over to you, Aitor.
Yep. Good afternoon, everyone. So I am Aitor Zubeldia. I belong to the capital markets team in Millennium BCP. My main responsibility is to manage a 2.5 billion credit portfolio with a focus on SSAs, coverage, and credit, mainly investment grade. Previously, I worked in IM Asset Management, where I was in the fixed income team as well, where I was a portfolio manager for several mutual funds with different risk profiles, from money market to interest rate. I want to say thank you to Bloomberg Intelligence, to Mahesh, and to the Evenco International team for inviting me to the panel and to bring me to discuss this exciting topic.
Gary?
Yes. Hello all, happy to be here with you today. My name is Gary Giro. I'm a French citizen located in Switzerland, and after living 8 years in Luxembourg, I am currently bond specialist for BNP Paribas Wealth Management. I got 12 years of experience in investment management as portfolio manager and analyst, and I mostly manage fixed income funds with a focus on corporate bonds.
Over to you, Brendan.
Oh, hi everyone. My name is Brendan McLean, and I'm a portfolio manager at the London-based Greenram Capital. We are a single family office, and we've exposures from various different asset classes, but credit is gaining a lot of traction, and we try and blend that with our macro view. So yeah, looking forward to the discussion.
Right. Thank you all for joining us in this Evenco and Bloomberg Intelligence webinar. So I know that all of us have a bias towards credit, but before we get into credit, I think we need to address the topic of this webinar, which is inflationary environment. So before we take any market views, we first need to discuss, what is our quick inflationary outlook. Inflation has been quite stubborn. It's not been coming down as the central banks would want. So, for example, in the US, we are looking at 4.2% by the end of the year for US CPI, and for Eurozone, we are looking at about 5.6%, slightly higher. So I would quickly like a view on what do you guys think about the inflationary outlook on both sides of the Atlantic. Brendan?
Yeah, I mean, it is very difficult to, know what will happen. I mean, you try and look at central banks for guidance, but even they struggle. If you remember, just out of COVID, central banks said inflation was going to be transitory. That turned out to be wrong. It's very stubborn, and even recently, the US being caught out by SVP, completely changing their view on what will happen. So it is a challenge, but I think it'll remain quite stubborn and quite high and make it difficult for central banks to, reduce rates. Right.
I would also like to point out that one of the reasons for this stickiness, of course, the war and commodity-related structural reasons is one of them, but we got this wage inflation story with strikes everywhere in Europe, whether it is UK, France, and so on. That is one of the reasons. The wage negotiations are another reason why I think inflation is sticky. Gary, any view on that?
Yeah, I mean, you're right on that. It's true that the core inflation remains elevated, especially on wages. But I think we get to think about where we come from. And inflation was really elevated, and right now it's under control. It's been well managed by central banks through their tighter monetary policies, sufficient rate hikes. Headline inflation is down for 6 months right now, both in the US and in Europe. Look at the commodity prices, they are down as well. So Yeah, it's true. If you look further, inflation expectations are quite high, the highest in a decade, but they have stabilized for a year right now, around 2.5%.
Unless you are the UK.
Yeah, UK is a bit specific. I agree, but
Yeah.
overall, I think the worst is
I
behind us. It's going on quite well. Yeah.
You wouldn't think that leaving Brexit aside, the sort of wage inflation related stickiness will persist in Europe?
I think it's good, and you can obviously see it when in wages. It's decelerating a little bit. So yeah, for me, yeah, it will stay elevated in the next decade, probably between 2 and 3%. But I think that the worst, the peak is behind us. Clearly, that has an important impact on the markets. But we will discuss that later on.
Which brings us to if inflation is not as sticky as some of the bears would worry, and if the central banks are doing their job, as Gary says, what is our outlook on future central bank actions, particularly on rate hikes? So just to give some color, here is what the market is pricing. So on the US, the market is pricing in about, maybe, with a difficulty, maybe a hike, and after that, cuts on the Fed, right? And on the ECB, the market is pricing in probably about 1.5 hikes, 2 hikes, and after that, stable. Now, Aitor, any view on central bank actions?
Yes, so I will have a different view in terms of the stickiness, because I will say that
Very good.
I expect rates higher for longer. Not that the amount of the hike that is so important, but the period that they will keep it up. Okay. I think that it will be the important thing to factor.
So you're a Fed pause guy, not a Fed pivot.
Exactly. I think that it's more important now to see what is the fundamental, let's say, outcome of these hikes of the last year before to go and start again to the losing of the monetary policy. I don't think that will bring the value to the economy that they will expect in the future.
Don't you think the ECB definitely has to hike though? I mean, I don't think they.
Yeah, for sure. I think that again between ECB and the Fed is like 3 to 6 months that it will keep that way.
How many hikes do you think the ECB would make? I mean, the market is pricing in that they will get to 3 hikes and then pause.
No, I would say that 3 hikes for sure, and the terminal rate more in the 3.75, 4%. At the end, at the terminal rate, yeah.
Right. Any views on that, Brendan?
I would agree with that, but keeping rates high will damage the economy. So
I'm going to come to that topic next, but let's talk about hikes.
Yeah, they might be more inclined to, once they get some signals, to reduce it as quick as they can to have growth. So I think they'll try and get the rate to come down quite quickly once inflation's under control.
Let's define what do we mean by inflation under control. I don't think the 2% target that we are all used to is happening. So at what level would, obviously it's a crystal ball, but approximate band of inflation at which the central banks would say, okay, I think we're done with targeting inflation now. Like for example, year-end forecasts are being shown as like about 4.5% US and about 5.5% Europe. Is that good enough?
I would think it's a bit high. Closer maybe to 3-4% would make more sense. Although obviously it's still far from the 2% target, but I think 2%'s not realistic. Maybe 3 is the new 2.
Yeah, which means I think probably the higher for longer story is going to play out, as Aitor has mentioned. What do you think?
Yeah, I guess, that could happen. It's just if it does, I think the central banks will be quick to pivot if inflation does come down. If wages, if more people get unemployed and wages aren't as sticky, they would be incentivized to change it. It could, if inflation remains high for longer, they'll keep rates. But if there is any sign of it declining. I think they'll be trigger happy to reduce rates.
Right. Now that brings us to, if we are, do they need to worry and target growth? Now, with the hikes that have already happened, particularly in the US, it's a big, heavy US problem, this one, because the Fed is far advanced in terms of monetary policy than, let's say, the ECB. So markets are pricing in, like if you look at the ECFC function on the terminal, markets are pricing in a 65% probability of recession in the US and about 45% probability of recession in Europe. Now, all that is because the ECB is at a much lower level in terms of rates. Now, I'll ask all three of you, do you believe that we are going to have a recession in Europe and in the US? So let's start with Aitor.
Yes, so I do believe that we will get to a recession in both sides of the Atlantic. Is that because
of your very aggressive rate view, though?
Yes, sure. And these financial conditions are really tight, and this will be a hurt in the economy, and they will keep it tighter for longer.
But that brings me to the question. I can see on both sides of the Atlantic, financial conditions are already significantly tighter.
Right.
Because credit conditions are very tight, banks are not lending as much. If that is the case, why bother hiking?
Because we don't see that in the data.
In the inflation, you mean?
Exactly.
Right.
And it has been a stickiness in the terms that fundamentally we have adjusted some parts of the economy, but if we look to household spending, I don't think that the adjustment has been. I think it will be has been quite limited so far.
Right.
In the Eurozone.
So you believe there will be a recession on both sides of the Atlantic. So let me take it to the next level. How many quarters?
Yeah, that's the thing. I will say that in Europe, maybe in first quarter of next year.
And for how long?
That I cannot know.
One or 2 quarters. I mean,
yeah.
I don't think
two quarters. 2 quarters, I would say.
2 quarters. Okay. I don't think even the biggest bear is going to say more than 2 quarters, right?
No way. But it's make the difference 1 quarter or 2 quarters.
1 quarter or 2 quarters, exactly. What about the US though? 1 quarter?
Yes, 1 quarter. I would think they will adjust.
And timing wise, is it the fourth quarter of 23 or first quarter of 24?
Fourth quarter of 23.
Fourth quarter of 23. Okay.
Yeah.
Gary?
Yeah, for me, I think we are clearly near the end of this tightening cycle. So probably one rate hike by the Fed. And bear in mind that even if they don't hike further, it's already tighter. So that's why we will have this negative effect on the global economy. We will have this recession, but it's inevitable. It's the only way that you can reduce the inflation. That's the only solution here. But it's gonna be a nice recession, I would say. Very slow, smooth. So probably two quarters, but maybe 1 to 1.5 years for very slow growth, so that we can reduce this inflation before probably easing a little bit the monetary condition, so that the growth can rebound after that.
Wouldn't you think instead of skirting recession, which is not what particularly the Fed wants to do, they might make peace with the fact that 4 is the new 2, maybe, and then avoid recession? How about that?
I think regarding the previous question, clearly we have lived in the 1 to 2% inflation for the last decade. The next decade is going to be 2 to 3. It's going to be 2 to 3. So and that's why it's very well managed by central banks. Look at the inflation expectation, both in the US and in Europe. We are at 2.5, and I think that's the new normal. So 2.5 it's clearly going to be the target. 2.5, 3%. That's our target. Yeah.
Brendan, recession probabilities, recession chances, when, how long?
I think it's highly likely there'll be a recession, at least later this year, and growth will be quite slow for a period after. So it might dip in and out of a technical recession, but maybe likely that'll, growth will be quite flat for a year or so. So recession later this year, and then for 24, quite flat growth, and then picking up later in 24.
Okay. My personal opinion, I'm in the Powell camp that most probably the US would avoid recession and will have a sort of softer landing, very shallow growth. So if you look at the US growth rate forecasted by the consensus, and you can see no quarter is forecasted to have a recession. The Q4 23 is 0.2%. I am more in that camp. That the economy will just skirt recession, and we'll have low growth. Low means like 1-ish or below 1-ish growth for some time. We shall see. That brings us to, particularly in Europe, I think we have to discuss before we move on. What do we think of central bank action on quantitative tightening? Because the ECB has started QT from the beginning of March. They said that overall in the standard QE, not the pandemic QE, the standard QE, they will not be replacing about half the redemptions in total. Obviously, they use their discretion. So just for the benefit of our listeners, I can confirm that they more or less didn't replace any redemptions of covered bonds, any replacements of ABS, about 75-80% of corporate bonds. But in government bonds, they replaced well above half, right? So they've covered government bonds in return for, tightening on the other purchases that they've had. So the QE program is going to go through. There's going to be a new announcement in June about what they want to do in the future for QT. So any further opinions on that? I know Aitor is very keen, so we're going to ask him about ECB QT view.
Right. So to put in context your numbers, that represents around 50% of the portfolio maturities over the
Correct.
period.
Correct. 15 billion a month.
Yeah, so 200 billion for the total period, right? More or less.
Yeah.
So I will say that in terms of liquidity, what this basically means is that excess of liquidity should decline about those 200 billion related to the QT, even though I think that the bulk of the reduction of the balance sheet from the ECB will be the maturing of the TLTROs that represents 1.5 trillion.
Correct.
Right?
TLTROs is the main route. Yeah.
Yeah. So that, as you mentioned, March data, they have been really, really down to govies, that they have to protect the AGB spread, right?
Correct.
But now looking to the effect of the QT in credit, and because the market is a discounting tool, I will say that we can assume that the spreads already price some of this decreasing of demand, and market participants absorbing those 200 billions of demand that will disappear. So the main consequence of this impact, in my view, is that we will continue to see the flight to quality in spreads and the reversion of the crowding out that we saw it happened several years ago. Now that we can have exposure to high yields with in a good credit names. So that's the impact that I think.
That brings us to the question: what will happen if the ECB in the June meeting comes out and says, very likely, by the way, comes out and says, we are not going to replace any redemptions from now. No more 50%, it will be 100%.
But I think some part of that impact will be mitigated by the flight to quality that I mentioned. So for higher grade names bonds, I will see that it will have a toll, but not that much. However, in my opinion, that will expose lower rated bonds and more liquid assets that have been financed, let's say, by private credit funds and alike. So I think that it will have a bigger impact in those high yield names than in the investment grade, because of this crowding out effect that will come down again to people migrating to the single A names and will mitigate some of
crowding in rather.
Exactly. Thank you.
Previously we had crowding out, and now we might have crowding in. Yes, I am of the opinion of that too. Okay, Brendan and I think Gary dropped out. But before he comes in, Brendan, any view on QT?
Yeah, I guess, if there's less, people buying these bonds, although people do expect it, I expect, spreads and yields to increase. Simple as that. And if in the June meeting they surprise investors, it'll even further exacerbate that challenge. I mean, there's a lot of money coming out of the market, so I wouldn't be surprised if spreads and yields started to go up.
Right. Gary, we were discussing ECB QT. You got any views on it?
Yeah, I'm sorry, I had a communication issue.
No problem.
Can you hear me right now?
Yeah, we can.
Okay.
Maybe you turn your. I think you're on your phone. Maybe you turn it horizontal.
Yeah, all right.
So that you're full screen.
Right. Yeah, it's gonna be better.
Much better.
Yeah, sorry about that.
No problem.
I'm a bit skeptical on the ECB. They are less experienced than the Fed. We've seen that they made some communication mistakes in the past, so I would be more prudent on that. We can expect some mistakes, over hikes, balance sheet management. Yeah, more than. Excuse me.
I think you're back on.
Yeah. Okay. That's it. So yeah, I would be more a bit more skeptical on what the ECB could do, and we can expect mistakes, obviously, and in the way they do it, in the time frame that they do it. So yeah, I would be more prudent on that.
I think me personally, I think given that they're behind the curve than the Fed in terms of hikes, the chance of a central bank mistake doing some damage is higher in the US than in Europe, which is why if you look at what the markets are pricing in, the probability of a recession is a lot higher in the US than in Europe. 65% chance in US, 45% chance in Europe. I think because they're behind, they have the advantage of stopping when they see a red flag. While the Fed, I think, is way ahead of the curve.
We could think about that ex ante, but we'll see. I wouldn't really count on that. Maybe they will cut later than expected. That's my scare.
So just for some clarity on what the market's pricing in for growth rates, let's say we are worried about a growth-related mistake. The Eurozone, first quarter, 0, second quarter, 0.1, third quarter, 0.2, fourth quarter, 0.2. This is what is being priced in, growth rates. The US, first quarter 1.6, second quarter 1.8, third quarter 0.8, fourth quarter 0.2, next quarter 0.1. So in terms of decline, the US decline is a lot sharper than us. We shall see. Now that brings us to the holy grail. I think the biggest driver of credit market returns, which is government bond moves, right? The Bund and the Treasury. So if you look at before we get to the Bund, we need to talk about the Treasuries because, that's essentially the pull factor, right? Even if you're in JGBs, you still need to look at what the UST is doing. So the US 10-year is about 3.5 now. Now, if the Fed is going to go one more time and then wait and then cut all in the space of this year, the US 2-year is at 4 now. So what sort of level are we looking at on the US 10-year? Are we looking for, a 3.75 type move? Or do we think that along with the cuts, the whole curve will bull steepen? So let's go one by one. I think Brendan is more eager on the US topic.
I think chances are it'll steepen, although given the volatility in the curve, it can change so quickly.
Yeah, it's 50, just for the benefit of our listeners, it's 55 basis points inverted now, 2 stents, and the market's forecasting it'll get down to about 30 by the end of this year, and it'll get to flat in the second quarter. So, Brendan.
Yeah, I guess I wouldn't be surprised if it keeps being not flat. Appreciate bank earnings have come out and sort of stabilized it and pushed it flatter, but I think it'll, keep being quite steep, in fact, and the market's a bit too optimistic.
Currently it is way too inverted, in my opinion. Yeah. So you believe that the 10-year will go wider first before going tighter?
I think it's a bit too optimistic at the moment. I think the bank earnings have caused it to flatten a bit too much, and then in the short term it'll go out. But the volatility will continue for the rest of the year at least.
Aitor, any view on the treasuries and treasury curve?
Same opinion. I will say
Right.
that the steepening more at the end of the year.
Yeah, I'm of the opinion that the U.S. Treasury, I mean, it's at 3.5 now. I don't see it going much wider than here. So 3.5, maybe 3.6 at the max before it starts coming down. The curve should bull steepen over time. Now that brings us to our area, which is the Eurozone and the Bund and the Bund curve. The Bund is at 2.4. It did come in from minus 60, as we know, right? It's 3% move. It's killed quite a few portfolios. It's killed credit returns last year, right? We all suffered. So, what do we think is going to happen to the Bund level as well as the curve? So let's talk the level first. Are we talking about a wider first and then come in, or unidirectional motion? Aitor.
Yeah, wider first, I think, in my opinion. Well, my view of
to what level
though?
To what level though? Is 2.4, are we thinking 2.75, or are we thinking just 2.5, 2.6?
Yeah, more 2.7, 2.6, 2.7, I will say that.
Right.
Is the level.
And on the curve, it's about 35 bips inverted now, 2 stems. Bund curve.
I will say that I think that the market will like to go again a bit inversion of the curve. So it will go again more of the minus 40, let's say minus 50.
So more inversion before.
And then, yeah.
Right. Exactly. Because the 2-year is at 2.8, and given the 2 hikes, that 2 or 3 hikes that we are pricing in, and given Aitor's view, maybe more hikes, right? So if that is the case, you probably will get more inversion. Yeah, that ties in with your view, I guess. Gary, any view on this?
I think both in the US and in Europe, we are pretty much at the fair value of the 10 years, both the US Treasury and the Bund 10 years. So that's clearly our target right now. But we are approaching the end of the rate tightening cycle, so we can expect volatility. But in the end, we will remain pretty much around that. If we enter, when we enter in the recession, obviously we will have the long end of the curve that will decline, but not by much, because we know if you have this target of inflation of 2 to 3%, I think the deposit rate will stay at the minimum 2%. That's why maybe 2 on the German 10 years, maybe 2.5. 3%, depending on the recession in the US, but not much. In terms of curve, it will take obviously some time to normalize a little bit, because we know that the rate will stay elevated at least for this year. So I would expect the normalization only in 24.
Yeah. So I mean, Gary is spot on in the sense the market's pricing in the curve to be flat in the first quarter of 2024. In terms of your 2% Bund view, market's pricing it in 2025, first quarter 2025. So it's going to take like about an year and a half before we get to, I think, the higher and lower trajectory is going to take a while for it to materialize. That's what the market's pricing in. My personal view, I think on the German side, not on the US side. On the US side, I think we are at the limit. On the German side, I think yes, is room for it to go a bit more before it comes down.
What's your target? 3, more than 3?
No. Like 2.75 types. No, not more than that. Because the curve also, I expect it to invert a bit more, and then flatten. Rather, I think flatten is the wrong word. Steepen, because we're coming from negative. Yeah. So I expect it to get steeper and steeper after a short while after the next 2 hikes. Right. That brings us to all of our favorite area, credit. And I think, my intention is to close this by about 2:45 so that we leave it some time for questions. So we've got about 15 minutes in credit. Let's talk about, I'm of the view that there is no other alternative. If you are in European fixed income, there is no other alternative. You have to be in credit. Discuss. Brandon.
Yeah, I mean, I guess it's a big statement. And I think for us, we tend to approach, credit quite globally. And if there's opportunities in the US, definitely allocate there. I guess in terms of credit, one attractive area we've seen is consumer loans have been quite recessionary proof and been able to navigate the, rise in rates, particularly because they're essentially floating and they can be passed along to customers.
Are you talking leverage loans? Or
no, I meant like personal loans, so like credit card loans and those type of
yeah,
assets.
Difficult to source though.
Sorry?
Difficult to source though.
Yeah, you need like a specialist manager, really. It's almost like a quasi private credit type of solution. But
yeah. So Aitor, what do you think? There is no other alternative. Tina.
Yeah. Well, in order to answer properly this question, I think that we need to define if we are investing from an asset allocation perspective, like Brandon mentioned, and in this case, I do see value in having investment grade short-dated credit with a 4% carry, let's say, in euro terms, with low volatility when compared to rates, for example. So it's something that we do not see for a long time, and the diversification effect here is clearly positive. But we have to keep in mind that this is still a negative real return investment, right? And the uncertainty in times like this, I think make a good argument to have a protection of your allocation in credit. Now, if you ask me about the spread duration within a credit portfolio, we will be way more cautious. Spreads have recovered from the widening of the March crisis. And October as well, yeah. And fundamentally, if we take out financials, corporates are below the 10-year median or where they have been the last 10 years. And they are clearly priced to perfection, I will say. So therefore, I do not see cheap to have it extended credit duration or spread duration in a portfolio. So to sum up my answer, things look differently from a yield perspective than from a spread perspective.
Right. So I want to zoom into your point that it is negative real yield. If so, why don't you go to positive real yield? Why don't you invest in high yield? What's your view on that? That's positive real yield. Yeah, 8%, nearly 8%. Almost next to nothing defaults. Yes, defaults will go up. We'll discuss that later on.
Right.
8%, very front-ended. It meets your credit. It meets all your criteria.
But I think that the problem will come from those high yield companies and the higher default rates due to lack of the access to capital. And now those companies will be facing two main risks. The first one will be the repricing of their liabilities. And as we all know, lower credit corporates tend to have short dating floating rate liabilities. So even those that do not need to come to the market, they will see how their liabilities are repriced or readjust to a 3.5% Euribor or a 5% SOFR in the US. And the second risk, as we mentioned at the end of the year, less activity due to at least a macroeconomic slowdown with less consumption, less investment, and therefore less activity overall will cause them that their income statement will suffer as well. So even though credit markets will still open for the high grade bonds, I don't see it with these default rates increasing that these companies will get the same access to capital. And for that reasons, I don't see it as a good investment in the risk return perspective right now.
I would like to clarify a few of those points. So first point in terms of, because we are all credit, I think it's going to get a very interesting discussion now. So first question is, are the markets really shut for high yield, or are they choosing not to borrow? Because if you look at 2020, 19, 20, 21, we've had bumper net supply. I tend to look at net because growth is very misleading. So if you look at net supply in high yield, because that's where the not being able to borrow question is. They've had, 2020 was a record, 2021 was close to it, net supply. 2022, they didn't borrow, and whatever maturities were left to go, they funded it through cash. So we had the index shrink by about 30 billion. record shrinkage, negative net supply. This year is still negative, but it's not like 2022. I would like to argue that they don't want to borrow. It's not like because they've already borrowed and funded themselves in 19, 20, 21. So there's less pressure. Now the argument to support that is if you look at the index and where the companies are in terms of fundamentals and so on, you can see in terms of defaults, we had only one. We track index defaults, by the way, non-index, because the portfolio manager is not touched by it. I tend not to bother. But if you look at the index, there's been one. In 23 months, there's been one default, Putco, Bondco. And we've also looked at potential default candidates, and we saw 5 names which are rated CCC minus or below. Everything else is sort of normal credit. CCC is not a bad rating in the sense. Doesn't mean you're going to default immediately, right? So that's one. In terms of market distress went to about, during peak Putin. We were talking about, 4.5%, 5%. Now it is at 3% distress pricing. So now getting back to you, do you really believe that there is going to be a default wave that faces a portfolio manager?
I think here it's clearly we need to be prudent because I guess when you looked at your figures, you look at 23, but we have to bear in mind that the company, they have to refinance 1 year before that. And the market at the moment is almost closed. So clearly for those high yield issuers, that's going to be difficult. On the double Bs, they will be able to refinance, but at a significant cost. On the single Bs, triple C, they have to change their financial policy because it's just not sustainable. If you look at exactly the yield for high yield names is around 8% at the moment.
Correct.
It means for a single B name, it means you have a 5 times debt to EBITDA leverage. It means interest represents 40% of your EBITDA, almost half of it. It's not sustainable. You have to invest CapEx, M&A, you have to pay tax, you have to return cash to shareholder. That's why on high yield names, I would be very selective. You need to go on companies that are very strong, that have shareholder support, that have no refinancing needs over the next 2 years. That's why on high yield, we would be a little bit more prudent. And regarding your question before that, clearly for us, the focus is on investment grade. Get the big picture here. You get in dollars, you get 5%. In euro, you get 4%. We are the highest level in a decade. It's just amazing. Correct. The credit spread, it's true that they tighten a little bit, but the default risk for investment grade is very limited. It's 10 basis points per year to compensate for that. Yeah. It means when you get 100%, it's not prudent. You obviously get 1% default risk on investment grade. For us, is the sweet spot here.
Yeah, and just to clarify to our listeners, we conduct an investor survey, and the survey was more or less resounding. Massive overweight on investment grade, underweight on double Bs. I mean, previously in the first quarter, by the way, in the first quarter, people were overweight double Bs and IG, neutral single B, underweight triple C. Now there is a massive underweight on single Bs as well, in addition to triple Cs. So the survey is in line with what you guys have said, like humongous overweight on IG. In terms of credit quality, what are you guys seeing in terms of what is your personal view, as well as what do you see in your portfolios of how credit quality is evolving? Gary.
Yeah, we obviously, the credit quality is deteriorating. That's due to the fundamentals and regarding the topics of the situation right now. You get inflation, you get pressure on margin because you have this input cost, wages, commodities that are clearly higher. It takes time to company to pass through those costs, depending on the industry. But that's clearly we have pressure on that. But more importantly, for high yield, you have higher financing cost. So that's an additional pressure. You have this dual effect, negative effect. So we don't really see it in credit rating upgrade and downgrade because you still have some upgrade on COVID highly impacted names, airlines, hostel, restaurants that benefit from upgrades. Overall, it's neutral, but we can expect some downgrade with an increase in default rate in the next 1 to 2 years.
Because if you look at credit quality, I mean, on the terminal for our listeners, you can look at the REATT function. We actually publish on it every quarter, and we've noticed that investment grade credit quality continues to improve. I mean, this is still Q1, by the way. Doesn't mean that it will be so later on. But high yield credit quality has been dropping in the last 3 quarters. So there are more downgrades than upgrades in high yield. There are double the number of upgrades in IG than downgrades. So sort of ties in with the view. Let's talk about the credit curve. Where, I mean, I know Aitor's view. I think Gary has also sort of mentioned. So over to Brendan on where on the credit curve do you want to be, both quality-wise and maturity-wise?
So I guess a maturity, definitely shorter term. Don't think you're really compensated for going further out. And I guess in terms of quality, we've been positioning ourselves for more of a default distress cycle. So we've been taking a lot more credit risk in the high yield names, trying to find managers that can find event-driven opportunities to restructure companies and get alpha that way. I think now is an attractive opportunity to sort of get ready for the default cycle that will likely happen.
I love it. So we found a guy who will take the other side.
Basically,
at 8%, I think there you will have people taking both sides. I think that's the beauty of it, right?
Yeah,
I think when we were at 4, it's a difficult sell. When you're at 8, I think there will be people who will be taking the other side. Now, while we are at it, US credit versus European credit. I think it's given that these are the 2 largest public markets in credit. Where do we think you should be? Obviously, there is a bit of an FX view on that. So we'll go around the table while you are at it, Brendan. US or European credit?
Well, from an active management perspective, looking at stress credits, I think European is better. There's less coverage, there's less managers in the space, and there's just more room for alpha. So in that regard, pick Europe.
Right. Aitor?
Yeah, the same. I would say that Europe, and if we go to financials, that is my overweight for the year, it will be even easier to get some alpha going to Europe. So banks are in really better shape than the US banks if we go deeply. And yeah, I would say.
Gary?
For us, that's a bit different because we work on both because that really depends on where the clients are located. But both sides of the Atlantic have interesting names. And in the US, if we look at that, look at the financial. The banks, US large banks, very low credit risk, strong capitalization. And if you look at their valuation, it's more attractive than we were before the crisis. So there is a good opportunities there.
Right. That brings us to the next topic. In the public markets, we also have loans. Any of you interested in the leverage loan market? I mean, do you guys invest or trade in it?
I guess I'll go. It was attractive whenever rates were rising a lot more, given the duration is very low.
Correct.
There is that buffer, and you don't have to worry about getting killed in that front. But
which last year happened, by the way. Everybody got killed, right? In the bond markets. It's a duration trade or negative duration trade. Yeah. Go on. Sorry.
But that feature is less attractive now. So more secured bonds is more of a preference, I suppose, out of the 2.
But given that the front end is at like 3.5 now, front end Euribor, right? It was the 3.5 plus loan spreads tend to be generally wider than public bonds, right? So if you add those 2 up, there the carry is even more. We are talking like an 8.5 plus on leverage loans.
Yeah, there's definitely
But
better return in it, but the thing in terms of the risk you're taking, it's not worth it at this point.
Would you take a senior CLO tranche?
Yeah, well, that's different than just
I know. I'm for the purpose of our listeners, we're trying to present views on the full range of credit products. So, do you guys invest in senior CLO tranches?
We haven't at the moment. It's because of investor sentiment. We didn't feel it would be repriced quickly enough versus other assets. So at the moment, no, but do appreciate there is long-term value in it.
Okay. Aitor or Gary, any views on loans?
I would be a bit
CLOs?
more skeptical, because it's maybe less liquid. It's in line with our view with single B, triple C, all those leverage loan related to private equity deal. I think we need a repricing on that, so I would be more skeptical. Yeah,
it has repriced, by the way. Leverage loan spreads are quite wide.
But
they're wider than high yield.
But you still need to refinance. Usually through new issuance, and compared to high yield, it's a bit different.
And that is why new issuance has dropped, because the loan spreads have widened so much, and Euribor is like 3.5, as we discussed before. Loan supply has been dwindling. Despite loan prices, thanks to floating rate, as Brandon mentioned, loan prices haven't taken a hit, but loan supply has taken a hit. They're not issuing now. So that brings us to any of you are players in the iTrax market, iTrax or CDS? All three of you? None of you?
We do price some. No, not much. We just look at it. We do price some CLNs, but not so much. But sometimes you get some attractive names, positive basis compared to bonds, but it depends. Yeah, but not so much active.
I guess for me, that's typically how we get our IG exposure, is almost through a leverage play in those type of assets. So we do have exposure to it, although it's sort of, when things go well, they work out. But, say during COVID, March 2020, there was significant losses. But if you can handle the risk, it's a nice leverage way to play IG. Right.
Yeah. So, for the benefit of our listeners, so iTrax main, the investment grade equivalent is at 85. That is, much tighter than where investment grade bond spreads are. So the iTrax crossover is at 450. That is in the ballpark. I mean, it's slightly tighter than high yield, but it's not as tight as main is compared to investment grade bond spreads, which is why I'm hearing that more people would like to get exposure directly to bonds. And also nowadays we are getting some interest in credit index futures, which directly mimic the bond indices, although they're tiny as of now. So I think in the interest of time, what I'll do is each of you give just a quick 1-minute closing note of your views on the views of the world, including credit, and then we'll close. We'll go in the alphabetical order. Aitor?
Yeah, to close the discussion, well, my view in a top-down perspective is, I will say that due to something that we don't have spoken about is the fiscal policy, we will see higher rates for longer. That will impact not just government bonds, but also credit. And that's why I will stay in the more safe side of credit, more investment grade, liquid assets, and will run away from the high yield loans and all those illiquid type of assets, getting a yield that we don't see for a long time.
Brendan?
Yep. So I see the most alpha coming from low-rated IG securities, and finding the right manager to navigate through the default cycle as companies struggle to refinance will be where the most return is.
Okay, Gary?
Yeah, for us, we are clearly positive on credit with a focus on investment grade. We have to keep in mind that for the last decade, it's been very difficult for fixed income, very low, even negative yield. It is past that, and we see that a lot of portfolio, they are still underexposed on fixed income. So it's a great opportunity to go back. Obviously, you can just put your money into deposit compared to cash, but if you go a little bit longer, like 3 to 5 years, you can lock in this yield for longer. And maybe we will not see such yield for a long time, because if we go into recession, strong recession, maybe the yields will decline. So clearly, our focus here is on investment grade, and I would be focused on high yield because we clearly have a credit risk here.
Okay. Just to quickly summarize, I am happy to take the opposite side of the investment grade and high yield view, just to stay controversial. I am of the opinion that in terms of likelihood, investment grade probably will deliver likelier positive returns, but high yield will probably deliver sizable positive returns if credit does deliver positive. So like Q1. So in Q1, for example, high yield beat investment grade. I'm of the opinion the gap will come down, but I think high yield will still edge it this year. Thank you, gentlemen. I think it was a wonderful conversation in this Evenco Bloomberg joint webinar, and we hope to do more of this later on. Thank you. And ladies and gentlemen, I think there will be a replay link probably later, so that anybody who wants to listen to the details can. With that, I open to questions. I haven't seen any till now, so let's see. All right, there are 5 of them actually. So how is the economic backdrop affecting your investment strategies? I think all 3 of you have answered that. With expecting continuous interest rate hikes up to 3.75 to 4% as mentioned, how will that influence real estate prices in UK and Europe, and possibly to borrow money for households? Any of you willing to take that? Impact on real estate.
That's clearly tough. That's one of the most impacted sector. We see it in commercial real estate, obviously. First, for those companies, you have this higher interest rate. They are highly leveraged, so it means higher financing cost. But it has also this dual effect on their portfolio valuation. That's why we see lots of loan to value increasing. And if you look at all those companies, they are all trying to sell some assets. So that's clearly a key focus here. On residential real estate, depends on the geography. It's a concern, obviously, but I think the yields right now have reached their tops. So it will normalize in the next couple of years.
The next question is, any views on green bonds in this inflationary cycle? If any of you are not going to take that, I will answer that question. Any of you want to take it, or should I? Okay, I'll take this. So what has happened into green bonds is during normal markets, green bonds were sought after. ESG was a major theme and so on. So there used to be a premium. So green yields or green spreads used to trade under. Now, what has happened is the green index, for example, trades at a discount. I mean, given the sort of credits it has and so on, and obviously it has quite a bit of financials and utilities. But nevertheless, the green premium has definitely come down in the crisis times. The market is not as obsessed with green and ESG right now. The next question is, do any of you use ETFs to access certain bonds, or take certain risks instead of directly investing in bonds?
Yes, I mean, I can quickly answer that. Yes, for clients who have difficulty to find liquidity, it's sometimes tough to find some liquidity right now, even if you are, especially if you're looking for short-term bond, for instance. So in some case, that could be easy, or for very specific team like cocos, for instance, you don't want to take any specific risk. That's the easiest way to go in the market. Yeah.
Yeah.
Right.
Just adding to what Gary said, I think this is the time to active management now to show what they were. So with this volatility and the divergence in the credit market, like we have discussed here, active management must outperform passive vehicles. So maybe in those asset classes or sub-asset classes like AT1s where credit risk is very idiosyncratic, active management will have and will add value to the clients, and more so nowadays, and create alpha.
Next question. Any views on covered bonds? Who wants to take that?
I think I can take that
Okay.
on cover bonds.
Go on, Aitor.
Cover bonds have come to the market again starting last year with big supply, something that we didn't see for a long time. Now cover bonds, in terms of the risk return that they offer, I will see it as a very valuable bet in the financial sector. It's trading in let's say, because it's priced above mid swaps, we see that the average cover bonds in Europe that has a really low risk that offer 30 basis points in returns above swaps. So we see that the market is now kind of shifting to those senior parts of the credit part of or the capital part of the banking system that will be safer, and going forward will be again let's say a portion of a credit fund in covered bonds.
Right. Next question. You know, the 60 portfolio style that used to be there in some of the lifestyle funds in big portfolio managers like BlackRock, those are changing. And the question is, what would be the impact of that 60-40 change on high yield? Who wants to take that?
Because I could take it, yeah, I would say as yields have gone up, as they rebalance, which they have done quite a lot more often, they'll probably not increase as much because IG offers quite a suitable yield, so they might not feel the need to take this additional risk. You know, given the equity side is so high and a lot of risk in it, I think there won't be as much high yield as expected because you can get suitable yields from IG.
Yep.
Yeah, on that, clear. Yeah, it's really nice strategy. For the last decade, it was during TINA, it was 100% equity. So
Yep.
right now, go back to the 40-60. That's really good, and especially if you go into investment grade, that's good to have equities in front of that. No need to go on high yield. I agree.
Next question. I think this is a big topic that we didn't discuss because of our European bias. What do we think of the debt ceilings saga that is going on in the US? Will it be just posturing, and will it all end well? Who wants to take that?
I guess I could take it. I think it just sounds like a recurring theme. I think it'll end well, but it'll be very dramatic and get a lot of tabloid press, and news flow, but it'll just roll over as it typically does.
Is anybody positioning for a US default, by the way?
Yeah, no, I mean,
right?
It's really interesting to look at the short-term volatility. That's clearly an issue. And if you look at the curve, the curve spike, the 2 and 3 months US Treasury move was quite very impressive. But in the end, it's non-event. It's just a political tactic.
Yeah, we all agree on that. I think last question, guys. What do we think of recovery rates going forward, and in which sectors do you think recovery rates are going to drop a lot? Who wants to take that?
I mean, I was working on that recently with a university here. We tried to really deep into the subject, and in fact, the recovery was quite good overall. 30, 40, even sometimes 50%, depending. So I would not be so afraid on that. For us, to be very prudent, we have 40% assumption for investment grade and 30% for high yield.
Unless you own an 81, I guess.
Yeah. No, on
From
that for
Suisse.
sure.
Yeah. So, gents, I think that ends all the questions. I think we've covered a vast area of topics. I think it's been a wonderful discussion. I hope all our listeners enjoyed.